Everybody's here? Okay. Great. Welcome back, everybody, for another session of the New Ideas in Insurance webinar series. Today, we're going to have Kyle Logue, who is the Douglas Kahn Collegiate Professor of Law at the University of Michigan. He is the author of dozens of articles in insurance law, but also in tax and tort law. And he's the co-author of a leading case book and was also one of the rapporteurs for the ALI's restatement of law of liability insurance. So he's always interesting, and he's here to talk about an incredibly interesting and possibly very, very current topic having to do with ransomware and cyber insurance. Next week's speaker will be Ronan Avraham talking about the dark side of insurance, which I'll leave you in suspense about what exactly that means, but it sounds creepy and ominous. And with that, I will turn it over to Kyle. I will keep a queue, so if you want to chat me a question or if you want to just raise your hand, we can manage the queue that way. And Kyle, the floor is all yours, or the E waves are all yours.
Thanks for having me. It's a pleasure to be here. So this paper, in a sense, arose out of my long-term interest in the topic of insuring against criminal activity. Saul Lidmore and I did a paper many years ago on insuring against terrorism and crime, and we focused on problems in the market for insurance against various kinds of crimes against property, including terrorism, and whether or not government intervention was useful or needed. We wrote the paper shortly after 9/11 and the enactment of the Terrorism Risk Insurance Act, and so there's that paper. This paper is about a kind of crime against property. So I'll start there. It's written with a former student of mine, Adam Schneiderman, who's now a federal law clerk. Let me start by asking the question, what is ransomware? Since the paper is about ransomware and ransomware insurance. Some of this will be obvious to people who've been following this in the news, but I'm going to be pretty basic just to make sure everybody's on the same page. So ransomware is just a kind of malware, right? It gets into your computer in various ways and blocks access to it. The only way you can get out is if you pay, right? That's hence the name. So the way it works, and I'm definitely not an expert, technical expert in this stuff. I know just enough to be able to understand it for the purposes of doing a paper on insurance for this stuff. But the idea is there's some key that will unlock the encryption, and the only person who has it is the ransomware attacker, right? So you negotiate with them and pay them almost always now through cryptocurrency. In fact, it was the sort of development of cryptocurrency that helped make this market so explosive and helped it grow so quickly. And they get you lots of different ways: email phishing schemes, just cracks in your software, various ways of getting at you, as you might imagine. And what's different? So one of the things that's very different about this from the paper on terrorism insurance is the goal here seems to be almost entirely profit-based, which is going to be bad and good. It's going to be a source of concern, but a potential for how we might respond. It's not to say that there isn't any other motivation lurking in the background. Some of the parties that engage in ransomware attacks are in countries that are not friendly to us, especially now. And do those countries protect the ransomware attackers and avoid prosecuting them for reasons other than profit? Sure, right? There's some sort of political motivation there. But the actual actors, the ones who are doing the attacks, who are negotiating with the victims, seem to be working on a for-profit basis. They seem to be highly profit motivated. So who's getting hit here? Everybody. There are individuals getting their laptops locked up. There's businesses of all sizes, local and state government offices. Atlanta's been hit, Baltimore's been hit, lots of other cities, schools, hospitals, police departments. A recent attack that affected a hospital resulted in a death, which may produce the first tort case rising out of all of this. We'll see how that goes. And then there's been attack on critical infrastructure. Some of your viewers may remember the attack on the Colonial Pipeline, which shut it down for a while and woke everyone up a bit to the problem of ransomware insurance. You can find a lot of stuff in the press immediately after this happened that talks about, like, America needs to wake up, do something about it, right? How big of a problem is it? So it's hard to know exactly how big a problem it is. The data on this is anecdotal, or partial. So I've not tried to nail it down. I've just pulled from some public sources. So this gives you a sense of the size of the ransomware payments. They're getting larger. You see the Colonial Pipeline is a little over 4 million, but there have been some bigger than that. Most of this data comes from these companies that help respond to ransomware attacks or prevent them. Here's another. Coveware is another sort of well-known company that does surveys of the people that they work for, and they have a sense of what the average and the median ransom payment. You can see that they dropped when the pandemic hit, and they've spiked again. Again, data is not that great necessarily on this. Wall Street Journal recently reported last fall that there's a big spike again. So everything's, the economy's buzzing again, and ransomware attacks are buzzing. So where does insurance come into all of this? So there are people, a lot of people actually, who are worried that the presence of insurance for this kind of attack, and there is insurance for this kind of attack, it's a form of property casualty cyber insurance, is making matters worse. And the most sort of obvious example of this is the ProPublica story that was sort of an in-depth investigation into the role that insurance is playing. And you can see their headline, pretty sensational. And they're, the second part of the headline where they say, even when public agencies and companies hit by ransomware could cover their files, insurers prefer to pay the ransom. Why? Because it's good for business. I suspect Ronan will bring this up next week in the darker side. But the argument is quite straightforward. It's just, if you have more money available to pay claims, it makes being in the business of cyberware attacks more profitable, right? And this is money that's set aside just for this. So it's just, raising the profitability increases the expected value of an attack, and so everybody is more, it's likely to increase attacks. So so a summary of our argument, and then I'll dig into it. These are the claims I'm going to try to defend. I'm going to argue that even if we don't do anything, no regulation whatsoever, it's at least possible that the market will adjust on its own and be okay, welfare enhancing overall. Then I'm going to talk about the problem of externalities that are giving us some worries. I'm going to argue that although the ransomware insurance market is a little different from the kidnap and ransom market, and so in this market, private ordering is unlikely to solve the problem, whereas there's at least an argument that private ordering or the market itself is solving a similar kind of externality in the kidnap and ransom insurance market. And then I'm going to talk about some things the government might do to help. Everybody seems to agree that the main thing the government can do to help is stop the crime. So sure, I agree with that. But barring that, what else might be done? And I'll talk a little bit about a modest additional intervention, federal regulation of the ransomware insurance market, some of which may already be happening. So I'm going to describe kind of how this could already be, in effect, is already happening. And then I'm going to talk about some more aggressive additional interventions if people think that what's happening isn't enough. And specifically, I'm going to talk about banning coverage for ransom attacks, but mandating or at least subsidizing coverage for the other costs of ransomware attacks. That is not the ransom payments, but the other things that can happen: business interruption costs, costs of restoring one's computer system. But let me start by saying something about the insurance policy. So what I did, my co-author and I spent a fair amount of time collecting insurance policies. There's no, let me just say this, there is no standardized ransomware language, just as there's no standardized cyber policy. So we just looked at as many policies as we could find from the insurers that are in the cyber market and tried to sort of figure out what things they had in common. The policies usually cover something like cyber extortion damages or cyber extortion losses. So they don't usually use the term ransomware. This is the term they use. Coverage usually includes reimbursement for payments to terminate the extortion event or to terminate the extortion threat. Again, they don't call it ransom, but that's what they mean. Some of the policies require ransom to have insurers' prior written consent. Others don't. Some policies have terms that say that consent shall not be unreasonably withheld. Others don't say that. So there's, if you analogize this to liability insurance, at least that analogy suggested itself to me. It's a little bit like sort of dividing the role of who's in charge of settling a lawsuit in a liability insurance context. Here, it's not a lawsuit; it's a negotiation with an extortionist, right? And who most of the policies seem to give the actual authority initially to the insured. You're in charge of this. It's up to you, but you can't pay anything out unless you get to cover the terminate the extortion event unless you get our permission, and we will not unreasonably withhold our permission. So a kind of balancing of the interests of the parties there in the contract. Coverage also includes some costs of cyber attacks other than payment of ransom, such as data and system recovery costs, incident response costs, business interruption costs. So I'm calling these the non-ransom costs of ransomware attacks. Okay, so what is the case for leaving the ransomware insurance market entirely alone? So some of this is just obvious, right? Like ransomware insurance provides the benefit of risk distribution. ProPublica did not emphasize this point. They were making a different point. But many of the victims are small. There are entities that it is not a surprise actually purchase insurance. Sometimes people wonder, why do large corporations buy insurance? Because they can diversify their risks through, through the stock market, right? And the shareholders can have diversified portfolios, and so there's literature on why that happens. A lot of these are not so big, and it's totally understandable why they have insurance, and insurance has a basic risk spreading function. So there's that, right? That's on one side. The more controversial question or assertion that I'll make, that this arises out of the work that I did with Omri Ben Shahar, who's here. Hey, Omri. Ransomware insurance can help reduce the risk of attacks, right? So the moral hazard problem of insurance is well known, but insurers also have incentives to help insurers have incentives to help their insureds reduce risks, and they have ways of counteracting moral hazard. You guys heard from Ken and Dan. This was a mirage. I will let you can go watch that, read that paper if you want to. There's a lot of in their paper that I agree with, but yeah. Putting that caveat to one side, let's talk about some of the tools. So I'm going to break them down into pre-breach tools and post-breach tools. The pre-breach tools that the insurer has that they can help use to help the insured reduce risk include premium discounts for best practices. What are the best practices? There's a bunch of them. It doesn't seem to be a mystery what they are. It's not like the insurers are the only ones who know what they are. It's pretty well known. There is some at the margin. Sometimes there'll be some disagreement about what's best, but a lot of these things are well accepted technologies. The problem is just getting people to do it and monitoring to make sure that they're doing it. One way to get people to do it is to give them a premium discount for doing it, right? And you could even get stronger. You could say, if you don't do it, we're going to cancel your coverage or deny claim, right? Like if you make these things a condition of payment. As it turns out, not a lot of insurers are doing this in an aggressive way. There's a really interesting paper by Shaheen Talesh and Brian Cunningham, which I'm citing here, where they interviewed a bunch of people in the field. And it turns out a lot of insurers just offer these pre-breach services, but don't really include serious teeth, and don't really push their insureds or work to make sure that there's regular compliance. The exception they mention in that paper is the insurance company AtBay, which I'll mention again later. Seems to be doing more of that. AtBay had a recent agreement with Microsoft where they sort of teamed up, and now AtBay customers, insureds, will agree to use a certain Microsoft package which lowers risks, and I guess AtBay continuously sort of monitors whether the insureds are continuing to keep all these things I mentioned here up to date, with consequences to the policyholders. But a lot of insurers are not doing it. I'll come back to that in a bit. Post-breach tools, everybody seems to think are pretty useful, right? So these are things that the insurance company do to help the policyholder minimize risk after there's been a successful attack and everything's locked up, right? So they get notified immediately. As I said, you can't pay until you've notified the insurer. And here's where the benefit comes in. The insurer requires, in the policies, they have provisions that require the insurer immediately to notify a team of responders. These are people who are if they're not on the payroll of the insurer, which actually usually they're not, they are on like a panel of experts recommended by the insurer. And it includes breach coaches who are highly specialized attorneys who sort of run the whole show, and then forensics companies whose job is to sort of figure out what went wrong and how to solve it, and then actual negotiators whose experience is negotiating with extortionists. And again, there seems to be a view that this works. I don't know how we would test this. I don't have data on whether or not it works, but the same people that Telesh and Cunningham interviewed that suggested that pre-breach services are not being fully used seem to be of the view that this matters a fair amount. So why isn't this enough? The first question is, why does the one that was raised by Telesh and Cunningham, why do so many insurers not do more? And here's some possibilities I just want to raise. One, the most optimistic one, and it's possible, right? The insurance market is moving in the right direction. That is, we just haven't reached an equilibrium yet. At bay maybe is the first, and there are others like it, but insurers will eventually get there, right? So on this view, let's just wait and see what happens. The most pessimistic view would be that insurers actually don't want to get there, right? This is a little bit in the ProPublica headline, but they profit from the existence of this. I think, again, Ronan's going to talk about next week the dark side of insurance, and insurers at some level need risk to be profitable. Somewhere in between is this view, which is sort of more my view, I guess. While insurers profit from reducing insurers' risks within certain limits, various factors undermine insurers' incentives to regulate risks, including externality. So my own view is that over wide ranges of risk, the insurance companies, when they're competing with each other, do have an incentive to help their policyholders reduce risk, but their incentive can be undermined by externalities. I'm not going to talk about I talk about several externalities in the paper. I'm going to focus on one in this talk, and it goes by either the name, the ransom externality, or to use Peter and Gideon's terms, it's the third-party externalities, and I'll just advertise here. So Anya Shortland's excellent 2019 book, Kidnap, talks about this externality in the context of kidnap and ransom insurance, and then Gideon and Peter, in a paper that I think you guys are going to be talking about later in the semester, talk about this as one of their examples of a kind of externality they call third-party moral hazard. But let me just talk about what it is. So how does the ransom externality work? Pretty straightforward. So it's collectively rational for everybody who might be subject to a ransomware attack to say credibly in advance, if they could, we will not pay, right? Because then it creates an incentive for no one to attack them. The problem is once you're attacked, once you're individually attacked successfully, now your incentives change, right? And agreeing to pay a ransom award, even a very high ransom, may be individually rational for you because it gets your business back going, it gets your hospital running again, gets the pipeline going. When it's not socially rational. So why would they have this incentive? Just to be crystal clear about it, the part that's socially harmful is the incentive that it creates for all the other attackers, because they know that if they do attack, a person will either, however you want to put it, defect, or their incentives will change because of the change in circumstances, and they will pay. And so this creates a sort of systemic increase in the incentive to attack, and the individual victim of the attack doesn't bear most of that cost, right? That's borne by everybody else in the all the other potential victims, right? So it's just a straightforward externality, right? But it's moral hazard of the third party, as you guys call it. Like it's not the insured's incentives that are being affected. It's the incentives of the potential attackers. Anyway, well-known problem in the kidnap and piracy context, where people have long been worried about this. So you can go back 10, 20, 30 years and you'll find occasional papers where people argue that we should ban, not just, we should ban payments of ransoms for kidnapping or piracy, and also ban insurance for the same sort of reason, because the insurance makes the problem worse. So now the question is, given that we have this externality, is there any way in which private ordering or the market itself can respond before we get to the government intervention possibilities? And there are some lessons from K&R insurance. And again, now I'm drawing heavily on Shortland's book, but so hers is like a sociological case study of kidnap and ransom insurance. So she went in and interviewed lots of people and talked to all the relevant players. And she came to a sort of optimistic conclusion at the end, which is that this ransom externality gets largely internalized through a single coordinating reinsurer, which is Lloyd's of London. So in the K&R market, Lloyd is the exclusive reinsurer of those risks. And so it has the power to set capital requirements and underwriting standards for all K&R insurance companies. And if there's a kidnap and ransom insurer that is not following best practices, that is not making its insureds follow best practices so that bad outcomes happen, then, and a bad outcome there would be really bad, right? If someone gets killed who was kidnapped, then Lloyd's can cut them off entirely. And so it's a pretty blunt instrument, but it is apparently effective one if people's testimony is to be believed. So what does she conclude? She thinks that Lloyd's has the mechanisms in place to enforce a tacit agreement between competing insurers to operate in the long-term interest of the market, right? To avoid this sort of ransom externality. All of them taken into account the cost to the system of encouraging too much kidnapping. So now my question is, what do I take from that to apply to the ransomware context? And my first conclusion is I'm not 100% sure that what's in the long-term interests of the kidnap and ransom insurance market is in society's long-term interest. I mean, the book was pretty persuasive to me that it's internalizing a lot of these externalities, but I still have a little bit of Ronan's concern that there could be a difference between what's in the interests of the insurance industry as a whole and what's in the interests of society. The other problem is even if you think that Lloyd's is able to do some useful cost internalizing, it just doesn't seem likely in the ransomware context because it's just very different. The ransomware insurance market is much larger, many more insurers and reinsurers. There's no dominant reinsurer. There's a lot of competition among insurers, which is good and bad, right? The competition among insurers means that we're going to have more competitive pricing, and it creates an incentive for competing for insurers, which can be part of what leads insurers to use the premium discounts to incentivize better behavior. But it's also the competition which can lead to the externality as well. So I guess my last thing was, maybe there's some government intervention that's called for. So so I'm going to talk a little bit about this modest one, and then I'll get to my banning idea in just a minute. So modest intervention. Let me tell you a little bit. So the first idea is just have a federal regulator that kind of does what Lloyd's does, in the sense of monitoring best practices and then punishing those that don't follow them. Monitoring insurers, and I guess insureds as well, and sort of helping the insurance industry to sort of enforce these best practices. So let me introduce you to the Office of Foreign Asset Control if you haven't heard of it. They're within the Treasury Department. They administer and enforce various economic and trade sanctions on foreign parties. Whenever you hear about the government, the U.S. government adding someone to the sanctions list, it's OFAC that enforces this. The list that they maintain is called the Specifically Designated Nations and Blocked Parties, or SDN list. I sometimes call it the naughty list. But if a ransomware attacker is on this list, or if they're operating out of a country that is covered by a comprehensive embargo, there are a few countries like that, then you can't transact with them. It's prohibited by federal law, and that includes paying them a ransom, right? So there is a sense in which at least a lot of ransomware payments, including payments by insurers, are currently potentially illegal. Okay, so how does OFAC oversight work? There are civil penalties that are administered on a strict liability basis for payments to these organizations. The same goes for facilitating ransomware payments on behalf of a victim. OFAC has made clear that that includes ransomware insurance coverage for the payments. But OFAC has some discretion. I guess this is not surprising. Their job is to enforce this, and they have some discretion. And so they take into account various mitigating factors. So what are those mitigating factors? And it turns out these are going to be relevant to the sort of vision of them as a regulator of the insurance market. So in September of last year, they issued an advisory that says this: meaningful steps taken to reduce the risk of extortion by sanctioned actor through adopting or improving cybersecurity practices will be considered a significant mitigating factor. And this particular thing they cite here, the CISA recommendations, are considered like the state-of-the-art best practices. So just to be clear, what they're saying is, so it's a kind of regulation, right? They're saying, if you are a cyber insurer, you should be aware that if your insureds follow these best practices, it dramatically, or to some extent, I don't know how much, reduces the possibility that after the fact, if they make a payment and the insurer reimburses for the payment, all parties involved will be subject to strict liability, serious civil sanctions, right? So it's like adding strong federal regulatory encouragement to best practices by the targets of these attacks, and also to the insurers. So one question is, so is that enough? Can we just stop there? And I don't know, maybe it isn't. One of my worries is all of this just raises the cost of insuring. And so the insurers will just start getting out of the market. Like, look, there's a potential fine. This is getting very expensive. We just need to get out of this market. And there's some evidence that that's happening a little bit. There have been some insurers in Europe that have totally withdrawn from offering ransomware insurance coverage. And so that could happen. That's part of what I'm worried about. So let's talk about some other possible interventions. And then I'll take a breath and we can get questions. So here's one idea, and I call it banning bad insurance and mandating or subsidizing the good insurance. More specifically, you could enact a ban of the coverage for the ransomware extortion payments themselves, and then you could mandate or subsidize coverage for the insurance coverage for non-ransom costs of ransomware attacks. So why would you do that? First, if you have both that ban and that mandate, it would increase the credibility of commitments by insurers never to pay ransom, right? Because for two reasons. One, they have less money to pay the ransom because they can't buy ransomware coverage, and they have less motivation to pay the ransom because they'll have more mandated or subsidized coverage for the cost of an attack, right? And the other reason to do it is to respond to the thing I was mentioning before: price increases and coverage reductions, and the costs that are being imposed on insurers creates a kind of cyber insurance gap where there's less and less coverage compared to how much risk people have. So subsidies and mandates apply to this, and a ban as well. And what would it look like? The ban itself could look something like what OFAC is doing, only expand the naughty list. I don't have a sense of what percentage of attackers are already on the list or covered by the ban, but this is one way the ban could look. The mandate can come in many forms. There are indirect supplier side mandates with subsidies, and by that I mean the example of Terrorism Risk Insurance Act. There, many of you will remember, property insurers are actually required to offer terrorism insurance by federal law. They just have to offer it. They don't have to offer it at any particular price. They have to offer it. And then terrorism risk insurance is subsidized in a particular way. On the supply side, there's a federal backstop, which we can go into if you want, but it's a kind of odd, sort of hidden, as yet uncalled on subsidy for terrorism insurance. So that's one kind of mandate. Or you could have direct consumer side mandates with subsidies. The Affordable Care Act is the example there. The individual mandate, you have to buy insurance. We no longer have a penalty for not following the mandate, but anyway, it at least have a precedent for it. And there are also consumer side tax subsidies to make it affordable, right? So we have some examples of this at the federal level. And of course, there are problems with all of this that we mentioned in the paper and would have to be taken seriously before doing anything about all this, right? I'm just sort of putting these things out on the table. But we don't really have experience at the federal level with bans on insurance payments before the OFAC bans. And bans can be difficult to enforce. The mandate worries me to some extent because whenever you have a mandate, you have to determine what's going to be required. The Affordable Care Act has pages of statute, and then the regulations that have come after it are also very long, explaining what has to be covered. So it's complicated. And then once you mandate coverage, now we have the problem of good old-fashioned first-party moral hazard with people having insurance for all these things now, and so that's a worry. So anyway, you guys get the basic idea. Maybe we should leave everything alone. Maybe it's enough that we get some nudges from a federal agency to encourage people to do better in terms of their cyber best practices, or to encourage insurers to encourage this. Maybe that's enough, but maybe we need to do more, and there needs to be more research, obviously, to figure out what the right thing to do is. But I'm going to stop there and then listen to everyone else.
Wonderful. Thank you very much. And I will take the cue and let's see. All right. Dan Schwartz looks like he's first in line. He got his hand up fast.
Did I stop sharing effectively?
You did. You're not sharing anything.
Hi, Kyle. How are
Hey, Dan.
you?
I'm good. How are you?
Good. So two questions. So the first one is just about the story about post-breach services. And essentially, this links to sort of the broader debate about, okay, well, is insurance reducing risk and increasing risk? But I think an important question there is, yeah, it's clear that insurers provide a service to policyholders post-breach that is of value. But the question I think that's important in this normative debate is, okay, but how does that service compare to the service that people would get if they didn't have insurance? And I will just say, so I actually have a project I'm doing now with Josephine Wolf and Daniel Woods, and this is going to link to the second one. We've heard a lot of stories about these services being sort of not as beneficial or as robust as what people would get if they just went and got them on their own. And the reason for that is insurers have these relationships, cyber insurers have these relationships with firms. That's all they do. And that drive down, from the insurer's perspective, what they do is they drive down costs. And there's sort of a template, a one size fits all template that is used. And so a lot of times actually sort of the post-breach services you get may not be as good. So I just wanted to, it's sort of part of the broader debate. It's probably a less useful point for you, but to me, that's just sort of, a point I wanted to make. The more useful point, and this actually links more directly to the work I'm doing with Daniel and Josephine, and we have a Lawfare blog post I can point you to that. But one of the things that's fascinating to me about this area, about why insurers do so little, is insurers, cyber insurers, they almost never get any information after a ransomware attack from the forensic providers who's doing it, or from the attorneys. And the reason for that is that the attorneys, who are basically lead everything, Daniel Woods is on level sort of like the coordinating the entire ransomware incident or attack, insist that if any information goes to the insurer regarding how the attack occurred, how the vulnerability occurred, what could have prevented it, anything, if there's any report, that waives privilege. And so what ends up happening is insurers have no idea what's happening in these, and a lot of times they don't learn anything from these cyber attacks, because they're not getting any information. And so one of the things that sort of we've been thinking about and exploring is, Okay, let's say I'm a little bit more optimistic than I obviously am about the capacity of insurers to um, reduce risk, and I believe the app-based story, which is, I think I heard the CEO of App talk, and he's a compelling guy, and I believe there's something there. Um, Having some sort of approach where you actually facilitate the sharing of information about what's happening to insurers so they know what the hell's going on and they can improve their underwriting is just super important to my view. Because I think a huge part of why insurers are not doing any of this um, uh, 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 risk reductions, they don't know what's going on. It's all hidden from them. And even one of the things we've seen in our interviews, and again, like we're sort of in the, is there's even a lot of fighting between the claims departments and the underwriting departments at insurers regarding this stuff. So the attorneys will say, sorry, we can't reveal any information from the forensics firms about how this firm got breached. The claims people are like, oh, okay. And the underwriting people, are you kidding me? Like, we need this stuff to price this policy and condition coverage and but they're not the one that they lose out at the end of the day. So it's just a different approach to potentially facilitating this. But I've been really interested in it, and I think that if you're a believer in the potential for insurance to do this, this is sort of a prerequisite, which is at least getting the insurers the information they need.
Yeah, a couple of responses. One on the thing about, I mean, for the point you made about people complaining that insurers are not doing as good a job as would be done by, if individuals hire their own sort of post-breach services. That may be, you hear the same thing with people whose cars are being fixed, like they have an auto accident and they say, my auto insurer makes me go to this company, and I know there's a company that does better, and that's better at this. They did better work, and it's true. It isn't clear which of those two alternative accounts is more likely to be describing what's overall welfare enhancing. Like, costs are costs, and it may be that using lower cost providers is better. I just don't. It's hard to know. But the stuff I love the idea that there's a I mean, I don't love it because I wish it weren't true, but I'm interested in the idea that privilege, the possibility of waiving privilege, is a roadblock. I've got this paper that I wrote about where I argued that insurance companies are not doing as much as they could because they're worried about incurring liability. That is, if they go too far into this regulation idea, they become they expose themselves to potential tort liability for having undertaken to help, right? And back when Omri and I were writing our paper, and we would talk to people, I would sometimes hear that they're worried about that sort of thing. So, fixing the privilege problem, right? Allowing them to share information in a way that doesn't waive privilege seems like an obvious thing to do.
Yeah.
But send me something about your lawfare blog.
I put it in the link in the chat, and
okay.
I'll email it to you as well. But
okay, I'm just now looking at the chat. Thanks.
Great. So Asaf Lubin is next, and nobody else is on the queue except for me.
So thank you, Kyle. I read the full article, and I enjoyed also listening to you talk about it. So this is great. I have a bunch of random thoughts that are responding to a bunch of random points you made throughout the presentation. So there's no logical order to them necessarily. But one point that I want to push back a little bit against is the idea that the ransomware externality is a third-party moral hazard.
Mm-hmm.
And there's the possibility and, in fact, likelihood of a second attack on the insured. Once you've paid out once, now you are a good pocket to be attacked again. And we've seen second attacks on victims in the ransomware context. There's also the understanding that even if you're not attacked, your industry might be attacked. So I'm part of a consortium of hospitals. I'm not going to be attacked, but the hospital nearby is going to be attacked. That's going to have costs on me because whatever, I'm now going to take a bunch more victims of whatever coming to my hospital because the other hospital is blocked. That's a harm to me. And then the third is, if ransomware is a national security threat, as the Biden administration claims that it is, then ransomware is a national security threat that impacts everyone. That is to say, the entire society is harmed, and I'm part of that society. And so, for example, if whatever, there's an attack on an oil pipeline, there's gas shortages, that's going to impact me. And so the question is how far you're going to extend the potential harms to you. So that's one point I wanted to make. The second is there's a lot of problems that I see with the OFAC that focus on OFAC here. And so I'm going to highlight a couple of them. One, since the first guidance in 2020, you highlighted the updated guidance, there's been, to my knowledge, zero enforcement of that guidance. And so part of the problem is that we have a threat that is in the air and zero enforcement. And that's not different, by the way, than the interagency recommendation by all these agencies that put out, please don't pay. We really don't want you to pay. But again, we're not going to take any action against you. In fact, in all the times that I've talked to FBI and Secret Service, who are two of the primary law enforcement agencies in the cybersecurity space, about the possibility of bans, everyone gets super squeamish. No one is in a position to actually compel a ban or recommend the introduction of a ban or enforce it. And the argument is always that A, they don't want to be in the business of making these life and death decisions, although I told them in response, but that's your job. That's literally what you do at the FBI. You make life and death decisions every day. Why is it here that you're not happy with that? And B, that there could be scenarios where we might want to see the payment because it's a hospital and there's people on the surgery room. And so complete bans are not a good solution. And so, but no one can articulate what a semi-ban looks like. And that's where we stop that discussion. The third thing I want to highlight with the OFAC thing is OFAC is built on a designation model. And I just don't think designations is the best way to deal with this problem because it requires us to constantly update a designation list. If ransomware is a kind of diversified threat, decentralized threat, our ability to work through it in that model is different than just a complete ban. And so if we don't work through OFAC, I'm curious to know who else has the authority here to introduce a ban. And the way federalism works here, it would seem to be that it would be a state-by-state solution, and that sounds horrible to me. And the last thing I just say, since you started with it, I also wonder why you don't focus on the need to standardize the language. I think that one thing we need to do first is to start talking in standardized language around insurance, cyber insurance policies generally, and in the ransomware context specifically. And then finally, and just because that was really interesting what Daniel just said, there's a lot of discussion around info sharing in cybersecurity that is outside of the insurance context. And so there is both growing regulation on the part of the federal government around compelling information sharing within particular industries with the government, and then CISA setting out particular databases that are aggregated and anonymized, so to not release any particular information. And similar models have been proposed, I know in Israel, because I've been involved with the Israeli National Cyber Directorate, to create these databases as an alternative to the fact that insurers aren't able to get cybersecurity claims data and cybersecurity incident and security response data.
Wow, that's a lot of good stuff. I just took notes on that. I'm gonna. I still have time to make some revisions, so some of that stuff I think might make it in the paper. I don't have a lot of response. Yeah, I'm not surprised that OFAC. I know OFAC hasn't, as far as I'm aware, made any enforcement decisions yet. That would be in the news, right? Wall Street Journal, front page. And so it's not clear to me that they're not doing anything. I can't get anyone there to talk to me. Part of what I think they're up to is creating uncertainty, intentionally creating uncertainty. That is, if you have OFAC, that like what you're saying is problematic for the whole thing. Like if it gets out that OFAC is doing nothing, now we have a problem. What we want is the fear that OFAC is doing something, and then maybe they are, maybe they aren't. Right. And so like this is sort of what we've done with kidnapping to some extent as well. Like the FBI says it's totally illegal. You're going to be in trouble if we're cooperating. And then, there's a lot of ransoms being paid. But the idea is at least send some signals out that there's someone here who might strike this down. But I agree with you. It feels pretty non-credible at the moment. And so maybe actually striking a few down wouldn't be bad. And I take your point about the designation model, right? That's a problem, having to constantly designate. But I'll think about these.
Okay, John Newman is next. You're very scrambled. Nope, you sound like you're just swallowed some helium. Sorry. That was incomprehensible. Want to try one more time? Nope, you don't like this. Okay, so we may have to skip you, John. I apologize, but that's a tech problem that's I don't know how to solve. Got no clues. It's very entertaining, but makes it completely impossible to understand you. I have Jacqueline Cushing and Jeff Thomas in that order. Jacqueline, you're up.
Mine is perhaps a rudimentary question, but you wrote that ransomware can enter a user system through several paths, including user error or vulnerabilities in the network itself. Do you think that insurance companies could address these vulnerabilities as a means of preventing ransomware attacks, or is there no motivation? And secondly, is systematically bolstering cybersecurity the solution to the problem, or do you think that that will just advance the sophistication of the attacks?
So good questions. As to the first one, this raises the issue that Dan Schwartz raised, right? Like, are insurers playing a helpful role here at all, right? Like, and if my argument that they should be, like, it's hard to get data on this, but is it kind of a theoretical argument in the sense that they are in a position to have expertise on this, although the information, some of it's not being shared with them, although they are seeing outcomes, right? They can see outcomes in cases. And they have a motivation to incentivize the policyholders because they're going to be on the hook, right? The insurance company is bonded with the insured, so they have an incentive. So if they took it seriously and said, look, here are the things that you have to do, right? You have to maintain the following cybersecurity protocols, and if you don't, your premium goes up automatically, or we will cancel you. I think that creates a powerful incentive. Now, the last point you made is a scary one, right? Like, is this just going to be an arms race that never ends? And one hopes that there's like a curve, like it gets the marginal cost of innovating on the attacker's side is going up or something, so that each time they innovate, it's a little bit harder for them. But I worry about that. Sure, it might be that they just keep getting better.
Okay, so I have Jeff Thomas and then Omri Ben-Shahar.
So I'm I like the analogy to kidnap insurance. And I think that the descriptive narrative is pretty compelling. I mean, I like that. What I'm curious about is on the insurer side of things, and I have an assumption that may be incorrect that you can perhaps address, and that is, my sense is that in cyber insurance, that there's sort of a bundling effect, that standalone ransomware, from my impression, and I don't know the market very well, but it seems like it's pretty unusual to have that as a standalone. That's usually part of a big package, right? And if that's the case, I think that part of the story about insurer behavior is that there's all kinds of noise going on the incentive side of things for the insurance company, that they view this as one small piece. And again, I don't have the data at my fingertips, and I only have some impressions, but it seems like, ransomware grabs headlines, but in terms of the overall cybersecurity risk, it's a relatively small part of it. And that, things like privacy intrusions that result in the loss of data of consumers and all of the, attendant costs and the penalties that are associated with that and so on, that's really the bigger threat, so to speak. But I don't really know. But my question is, first, whether there is that sort of noise effect and if the policies are structured that way. And then secondly, if that's true, what are your thoughts about it? How you try to unpack that to try to make a little stronger connection to the kidnapping insurance? Because the kidnapping insurance, my experience, again, is I'm a little naive about it, but it does seem more like a standalone kind of thing. At least it's going to be underwritten in sort of a separate way.
Yeah. So the policies I've seen, the extortion coverage is just a part of a broader package of coverages that are offered in a cyber policy. I do think that ransomware attacks are becoming a pretty substantial fraction of cyber attacks. They may be the majority at this point, but it's huge, and the reason is it's so effective. And you know, in terms of the profit model from the attacker's perspective, right? Like this is how you get paid, and from the insurer's perspective, the reason it's a problem. So the extent that it's a large fraction of overall attacks, it's just a huge risk for the insurers. The other thing is that paying the ransom, and this is part of the worry that ProPublica raised, paying the ransom could be cost minimizing, right, for the insurer. The insurer is on the hook for business interruption costs. It's on the hook for helping them restore their system. And paying a ransom, this is the worry, right? It might be relatively low compared to that. And so anyway, but it's possible that it's lost in the noise of other policies. Although I feel like it's a pretty large fraction. It is not separately reinsured the way that kidnap and ransom coverage is, right? Like that. I'm just taking Shortland's book on at face value. That all seems to be insured eventually with Lloyd's, even though the coverage might be sold in policies along with other parts of coverage. The kidnap part is insured through Lloyd's. But honestly, I'm not sure what I would do about it. Like if it turned out that it was a relatively minimal risk, then I would say it's not as big a problem as I think it is, right? Like if it's so small that it's not insurers aren't doing anything about it because it's a trivial fraction of the overall risk, I'm not sure I would do much about that if it were true. But I think it's a pretty substantial portion. Have I responded?
Yeah, I mean, I think so. I guess the question that I have is with respect to insurer incentives, that their economic incentives may not line up with what will be optimal from a societal standpoint and from the externality standpoint, and that the noise interferes with trying to optimize and creating the incentives to optimize, because they're optimizing in this larger spectrum. And then the externalities for the little smaller component may be really great for the smaller component, the high externalities, but insurers don't care so much because they have, the way they're managing the risk, the way they're grouping and classifying the risk, it's not a big deal for them. And your point is really a good one, that in fact the bundling may create the incentives to pay, which then increases the externalities and the third-party moral hazard problem.
I mean, one way to think about it is if the insurer, if insurers covered all the risk, like there were no, and there was a single insurer, like one, this is the Lloyd's model, sort of. There's one insurer that covers all of it. Then you wouldn't have the externality, right? You might have the worry that, they don't want the risk to completely disappear because their livelihood depends on it, but you wouldn't have the externality because it would all be insured. So we're sort of backing off from that step by step. We have lots of insurers, they don't cover everything. And the question is, can we get to something closer to where all those costs are being internalized?
I guess the one other piece, just to respond to that, and I'll stop. But the other thing that's going on here is that my sense of cyber insurance is that insurers are taking a little piece of cyber risk because there's a lot of money to be made there. There's really high risk. And so they're not taking very much of it. And they're in fact doing a kind of hedging with other kinds of risks against the cyber risk in order to capture the large profits. And so that bundling effect that I'm talking about in terms of the policy forms actually becomes a larger bundling effect in terms of their risk portfolio, right? And that they're using hedging mechanisms to try to take this, and that they're not going to have the right incentives because they're never going to take enough risk for it really to hit their bottom line. They're just looking to get those quick profits, and so they're going to keep 5% or 3% of their portfolio in cyber risk.
This suggests that they would not like a mandate.
Okay, Omri.
Hi, Kyle. This is really interesting problem, and I see how hard it is to solve, thinking about solutions from different ends. So I take it, and this is not a well-formed thought, but I take it that the problem arises from the fact that the attackers expect insurance money. And if a small fraction of their targets were insured, their incentive would be different compared to a scenario in which everyone is insured. Also, they don't know who is insured, right? So part of the kind of the balance that's happening here is, imagine a scenario in which it was possible to signal whether you're insured and what is your policy limit. You would want to signal that you're not insured or that you're insured for only $10,000. The problem, the externality here is a problem of coordination, right? As if the market, if the targets were able to collectively not insure, right, then the problem would remain only amongst those of them who have deep pockets. Not sure. Maybe those will insure, but they don't really need to insure. The target can self-insure. So I don't know where all of this leads me to think, but it is in some sense a problem of imperfect information or incomplete information, that we don't really know the feature that is most important for the attacker to know, which is whether your target is insured, and you will have the incentive to do so when you expect that at least there is significant probability that they are.
Right. I think it's a combination of things. It's the information problem that you described, but then it's a coordination problem, right? Because each party, potential target, has an incentive to defect from what would be globally welfare maximizing, right? To say not to get insurance. So a defection is buying insurance, right? Like and just not disclosing it. Like I don't want to, because I could still get attacked. What would be rational for me is to join with everyone else in saying I'm not going to get insurance and I'm not going to pay, but secretly to have insurance in case I am attacked so that I can pay. And if the problem is, can you credibly do the latter in a world without a ban of some sort?
Yeah. Now,
right?
how could you ever prove that you didn't have insurance? What would that even? What conceptually could that even look like?
Yeah, I don't know.
You can prove that you do have it, but you can't prove that you don't have it.
You can never prove that you don't have it.
Yeah.
Yeah, you can never prove that you don't have it. Yeah, so that's some information problem too, right? Like they're going to assume, I guess, you have it, or they're going to make some calculation, probabilistic calculation, on whether you have it or not. I mean, ProPublica kind of assume that they all know whether they have it or not, but the people I talk to in the industry says it's hard for them to know in advance. They fish once they've attacked and they get in. So they're not basing their attacks on who has insurance and who doesn't. They're just, the attacks are very easy to send out. They're attacking everyone. They send them, and then whoever they wind up hitting, they go in and say, all right, you must have an insurance policy. And the ones who don't say, no, I don't. And sometimes the negotiations end, sometimes they don't. But they don't really know in advance who has policies and who doesn't. At least that's what I've been told.
Let me just follow up on that. They don't know if you have insurance. If you don't have, you tell them I don't have insurance, they don't believe you. So and then Peter says, but they do know if you do have. You come up and you bring the insurer. So but they don't know that the insurer, how much you're insured for. They don't know what the insurer says. Okay, I'm here. I have $500,000. That's what they bought, but it's really a $10 million policy. Or you have two insurers.
Right.
You only bring the front one, which is the cheap. So there's a lot of interesting things that can happen in the context of this problem of incomplete information.
I agree. I like your strategy. Have insurance. Have the insurer come in and say it's not much coverage. I'm here just to help. Yeah, definitely don't reveal how much coverage you have. But the problem is, unless you have everybody doing this, I mean, this could affect the negotiation, right? But unless you have everyone doing this, there's still going to be an incentive for them to attack.
Can I just ask a question about your OFAC sort of strategy, which this is all very new to me, so I am really completely ignorant. But one of the things I took from the Shortland book was that part of what the reinsurers at Lloyd's did was not just say what best practices were and refuse to allow you to reinsure if you didn't follow them. They were also following every deal, every payment, and saying like, you just overpaid, dude, because the going rate for a CEO in Venezuela is not $1 million, it's only 500,000. And if you try to, sort of pay too much because it's important to you to get out of this, then we're going to kick you out of the club in some sense. And that requires a degree of like constant monitoring and chatter and, being up on everything that it seems hard for me to imagine that OFAC, I know nothing about it, but any government bureaucracy could possibly manage. It's just, they're not nearly tuned in enough to be following the day-to-day stuff. And that seems to be important. Am I wrong? Is that an important part of the story, which they're just not going to be able to do?
Yes, I should have emphasized that. I said it a little bit in the paper, but I need to make it clear. I don't actually think OFAC can do what Lloyd's is doing. I agree with that. OFAC, I mean, certainly, I mean, the things that Asaf said made me feel even more strongly that's the case. But even before that, that's just not their job, right? They don't have any money at stake either, right? Like Lloyd's, whether they make a profit depends on how well they do this. So it's my lack of faith in OFAC as a regulator, which led me to the other recommendations, honestly.
Gotcha. Okay, so it is by my watch clock 5:01, which is past the witching hour. Anybody who wants to disappear can do so. Kyle, you willing to stick around for another 5 or 10 minutes just to keep talking if anybody wants to do that? Great.
And I'm reading the stuff in the chat. Thanks, folks, for putting that stuff there.
Yeah, there's a lot of.
Is it possible to get a copy of the chat, or is that not something?
Travis, I think we can do that pretty easily. The recording includes the chat, and I think the recording will be available to you. I'm not 100% sure about that, but I'm pretty confident. So yeah, that should be a record of all this. Who else wants to chime in? Nope, I'm not seeing any hands. Wait, there's one. Sasha.
I have a hand.
Please.
Riley firing off rounds in the chat here. Thanks for this. This is great, right? So cyber insurance is super. I've been following it for a while, and there's been a lot of movement, a lot of change over the past couple of years, specifically because of ransomware. So you're right to follow this train of thought. Carriers were worried a number of years ago. They're always worried about aggregated loss, right? Systemic loss, whatever. And they were thinking that cloud and IoT was going to be the place that would really cause them pain. But you're right that the surge of ransomware has taken off. It's just skyrocketed. In the beginning, that the ransoms would be a few 100,000, tens of thousands, a few 100,000. Now we're seeing tens of millions and stuff. So it's nuts. And that's affecting their profits, right? So NAIC in this report they do data calls of carriers throughout the US who all report back to them about number of claims, number of policies, and they can determine the loss ratio, right? So some carriers are losing as much as they're collecting in premiums, which is crazy. Others aren't. And so there's this great variation, there's this great distribution between those profit losses, which is a pretty great question, and it's a research question in itself. Like, what's driving that? Why are some carriers doing well and others not? Someone's got to win, right? So maybe it's just luck, but who knows? But the real issue of this is very salacious to think that insurance is driving this market for ransomware, and we've seen these stories pop up a number of times over the past few years, but no one's really been able to answer it. It's all been speculation, right? I mean, and we've tried, right? It would be a wonderful research project to be able to show that empirically. But as we've mentioned, nobody has information on policyholders, which companies do and don't have these policies. Like, it just doesn't exist. There was one story by allegedly a journalist interviewing a hacker, right? One of these ransomware criminals, and who asked them, hey, are you going after carriers? Because you could collect that information directly from the carrier if you could steal it. And they said, oh yes, that's a gold mine of a place. And maybe that's true. I guess, I can either confirm or deny it or refute it. But it would be obviously a great opportunity for some empirical research, but otherwise, yeah, the information just isn't there yet. And I don't know of any place to get it, honestly. Somebody suggested in the chat with government entities that maybe through public FOIA requests, you could take state agencies, municipalities, maybe law enforcement offices, something like that, and collect it that systematically, which may be an opportunity. If anyone does, they should definitely acknowledge me in that work. But it would be a wonderful thing to do. But otherwise, I don't know of any other place to do it. So maybe someday. Anyway, thank you. Great presentation.
Thanks. I'm seeing some posts in the notes that some of this is publicly available, but
All right,
so
tough.
Yeah, so two quick things. One is on the disclosure side. Part of the issue with the public entities, though, is that they're not all going to commercial insurers to cover them. And so there's also risk pools environment here and municipal risk pools and so on. And so that also adds to complexity. I want to make sure I mention one other story that I think is interesting in the parallel between, and I talk a little about it in my paper, the insurability of cyber risk, on the parallel between kidnap and ransom insurance and ransomware insurance. And that is an episode with Attorney General Edwin Meese in the late 1980s, where he was debating a ban, what he was being proposed, a ban on kidnap and ransom insurance. And his reasoning for why not to ban it was the entire idea that insurers are incentivized to collaborate with law enforcement and with the federal government, because if they want to indemnify these kidnaps, one way that they can ensure lowering the cost, negotiating with the kidnappers, ensuring the return of the kidnapped CEO from Latin America, is through diplomatic processes and involvement of the foreign government. And we need embassies to be involved. We need to literally take that plane to drop the money that needs to be authorized by the foreign government. There's a lot of interest structure built into the insurance collaborating with the foreign government. In the cyber insurance context, however, everything has been privatized. Now we have foreign government officials who are working for private cybersecurity firms who are doing the negotiations for you. And there's no need to involve the government in any shape or form. And so for me, apropos what I was saying on the basic level of particular proposals like universalizing the language, another thing that you can think about, I think is pretty straightforward, is if you want to get money, the insurer needs to notify the government first. To me, that's straightforward, especially if you take as a baseline that we should have more law enforcement involvement here. The only way to get more law enforcement involvement is law enforcement knows about the ransomware in the first place. And that's one way to compel disclosure to law enforcement in these incidents.
Interesting. Yeah, that's useful. So OFAC says they require that, but what I'm hearing is you don't think they enforce it.
Yeah, and I think for this, OFAC to me sits in the same realm of people in the government who are very squeamish about doing something affirmative in this space.
I might just add an anecdote that I learned somewhere in the last couple of years about how when Italy tried to ban ransom payments, this is regular ransom, not cyber, they had instituted a policy whereby to really prevent ransom payments, they would freeze your bank account at the moment that they found out that you had been a kidnap victim. So of course nobody would report any kidnappings whatsoever because they would lose all control. Like literally couldn't pay for their groceries anymore if they were known to the police. So you got to be careful about over enforcement as well. Maybe not in this context, but
took a bite out of kidnapping though, I bet.
It seemed to, maybe. Yeah, hard to know. Okay, any further comments or questions? I'm looking around and not seeing anybody, so maybe it's time for us just to draw this fascinating thing to a close with many, many thanks, Kyle. That was really great. I learned a tremendous amount and really appreciate it. Take care, everybody. See you next week.